This lecture introduces you to the content and the structure of a balance sheet. Thinking back to when we talked about wealth and recalling that wealth is measured at a point in time, you'll see that the balance sheet provides the information for us to do this, that is, assets minus liabilities. You'll also be introduced to some important terminology and definitions. Okay, so the purpose of the balance sheet is this. It is a statement at a point in time. We've already said that in previous discussions and recordings. A point in time which shows all of the resources controlled by that entity and all the obligations due. So the resources controlled by the entity are its assets, and the obligations due by the entity are its liabilities. And if we turn around the algebra in that accounting equation that we see there, we can turn it around so that equity equals assets minus liabilities, and that's the way we presented net worth or wealth in the previous discussion. Notice that the balance sheet contains 3 of the 5 elements. So now at this point we have all 5 of the 5 elements safely located in 2 of the financial statements. If we go back to the discussion about the income statement, the 2 elements that are in there are revenue and expenses. Here in the balance sheet are the remaining 3, assets, liabilities and equity. So now what you've got is 5 elements, which we've already discussed and defined, and how these 5 elements are always reported in the 2 statements, the income statement and the balance sheet. And of course, in the set of 3 statements, the third one is the statement of cash flows, and cash flows, as we know, is an asset. So it's a subset of the element assets. So what we can learn from a balance sheet is a lot of information, but being general about it, information about the investing and financing decisions of the business, and also information about the liquidity position of that business at a point in time. So just going back and discussing the 3 elements now, just to refresh that in your thinking. Assets. Assets are defined as resources which are controlled by the entity. They represent future economic benefit, which is controlled by the business and which will eventually flow into the entity. Assets get to be in the financial statement, in this case the balance sheet, only when it's probable that the future economic benefits will in fact be there. So we're not guessing that they might be there, we actually know that they will be. And we have a basis of reliable measurement of the value of that asset. Now we had a discussion in the previous presentation about various methods of valuation, and we concluded as part of that that the default valuation method is historic cost. Liabilities. The second of the 3 elements that is in the balance sheet. Liabilities are present obligations which will be settled or extinguished by paying them out in the future. A couple of important pieces in the language there. The obligation must exist now, and it must be in a format which is sufficiently certain that we actually know what the payout in the future is going to be. If we don't have both of those elements in place, then liabilities will not be recognised in the financial statements. We classify all assets and liabilities into 2 subcategories, which are current and non-current. And current and non-current have the same meaning for both assets and liabilities. They have to do with when the benefits flow. So current assets or liabilities will be realised, that's assets, or settled, liabilities, within the current operating cycle, or, if that's uncertain, within the next 12 months. So what that tells us, in yours and my language, is that a current asset is one which will turn itself into cash in the next 12 months. So we hope that our accounts receivable will be paid within the next 12 months. We expect with liabilities, current liabilities, that we will pay them, meet that obligation within the next 12 months. So we expect to pay our creditors, accounts payable, probably in 30 days or maybe 45 days. We will certainly be expecting to pay them within the next 12 months. Now, any asset or liability which can't be classified as current is by definition non-current, which means that it will be either realised or settled in a period of time which is further in the future than 12 months. Now, when we compare current assets and current liabilities, we get a great deal of power to learn about the liquidity position of the business. It's very important when we do that to make sure that we understand what is that business's operating model and environment, and be very careful not to look for lazy ways of doing this, which are referred to as rules of thumb. So let's look more specifically at current and non-current assets. Current assets, highly liquid assets, cash and cash equivalents. And as we'll see when you look at the third statement, the statement of cash flows, it's actually referring to both cash and cash equivalents. Now these current assets are expected to be realised, that's to say turn themselves into cash in the normal course of the entity's operating cycle, and that usually means 12 months. Non-current assets by definition fall through that definition, and they are every other type of asset. And so non-current assets will include land, plant, buildings, machinery, intangible assets such as copyright and patents, and other long-term investments. Again, short-term investments, that's current investments, will sit in the current asset bracket in the expectation that they will be realised in the next 12 months. Now for current and non-current liabilities. Well, parallel definitions here. Current liabilities are expected to be settled in the normal course of the operating cycle or within the next 12 months. So we'd expect to pay our creditors, our accounts payable, probably within 30 days, maybe a little longer. Perhaps we might be looking at the current portions of loan funding, and so the portions of loans that have to be repaid within the next 12 months will be a current liability. The portions of loans that are paid further into the future will be a non-current liability. And then finally, of the three elements that are in the balance sheet is equity. Same definition again as we had in Module 1, and there is the accounting equation with the algebra reversed, so that equity is calculated by all of the assets minus all of the liabilities. And the examples of things that you will see when you look at the balance sheet, and in the equity section you'll see owner's equity, you will see retained earnings, as the name implies, profits which have been kept in the business and not paid out to owners. Depending on the ownership structure, you may see partner's equity or shareholders' equity. If it's a shareholders' equity, then you know you're dealing with a company, and the shareholders' equity will be in the form of shares. Partner equity will be contributions made by each partner, again, plus any earnings which have been retained in the business.